Well, g'day. Welcome back to wherever you're listening from. We're on for another episode of the StoneX Australian Cattle and Beef Market Report. My name is Ripley Atkinson, the Australian Livestock and Commodities Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian beef industry to help the sector manage market and price volatility with our Australian cattle swap. We're brought to you by StoneX Group, a Nasdaq-listed global financial services network with 100 years of experience in global commodity markets. Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss, and you should fully understand the risks prior to trading. Past results are not necessarily indicative of future results. Well, with the first half of 2025 in the review, I thought it'd be a good opportunity for us to have a look at how the first half of this year's performed. In this episode, we're going to have a look at the top line figures for the first 6 months of 2025, how the impact of late March rains effectively changed the game and changed the market for this year, and subsequently the strength of cattle supply across the board, aligning from a physical perspective through to slaughter and exports. But importantly, despite those three factors, and particularly the strength of cattle supply, the market itself has been quite resilient, and pricing and the market generally has performed quite well. I'll finish with how exports have performed and some of the global factors that have played out or events that have played out in the first 6 months of this year. But before we get into it, we are releasing our H2 2025 Australian Cattle Market Outlook Report in the next week or so. I'll be going through that in the next podcast episode, so stay tuned. But let's get into this week. At a top line level, these were three figures, in my view, that I think have reflected the first 6 months of this year quite well. In the last couple of weeks, we've seen some markets and prices reach 2-year highs, but the first 6 months of this year generally has been quite solid. I think, when you look at pricing across the board, they're generally operating ahead of where they were placed last year. And now that we're closing out the first 6 months of this year, markets have stepped up again in the last fortnight particularly. I think that's a good outcome. Generally the markets have performed pretty well, particularly when you consider cattle slaughter in year to June volumes, on my estimates, are already 630,000 head in front of year to date 24 figures, which equates to about 14% ahead of last year's numbers. On top of that, our beef export volumes, as we know, have been breaking records. June, or the month of June itself, is on track for an all-time monthly record when data is released in the next few days. And overall, the first half of this year, volumes are about 100,000 tonnes in front of year-to-date 24 figures. We've got to remember year-to-date 24 numbers or in total, 2024 beef exports were a record. So it gives you a bit of an idea on the volume of cattle we're processing, 600,000 head plus in front of last year, and subsequently the volume we're exporting. So there's a lot of product around, but the market itself has remained quite resilient. And I think that, that collective nature of those three aspects is quite a positive when you think about how everything's tracking at the minute and all the other factors outside of the beef industry's control, which can have an effect on it. And some of that we'll touch on a bit later. But I'll start with the effect of that March rain. If you think back to, how March was performing prior to that rain arriving in the last sort of 10 days of that month, the markets were starting to come under a fair bit of pressure. Feedlots were starting to get very full, and the volume of cattle coming at feedlots was fairly significant. Following that rain, they said it was a blessing, for it to come, because it just slowed everything up and stopped the flow of numbers. Prices themselves were starting to come under a bit of pressure. You could get the sense that, there was a bit of, not fear in the market, but a bit of concern for the fact that, the north had generally missed out on a wet season completely. Parts of southern Queensland, northern New South Wales, were starting to get really dry, and that rain arrived and just turned things around. It, I would have hated to have seen how the market was going to perform if that rain didn't come. It really did have a big influence on generally how this year's going to perform right across the board. I don't think it can be to be understated. Following that, though, after that rain came, we did see it a bit in the weaner sales with the demand from northern New South Wales, Queensland buying cattle out of the weaner sales, both backgrounders and feedlotters. But, it was even more pronounced when that rain finished and country could start to dry out, the effect of, northern buyers in southern markets down, Riverina in the southern tablelands in New South Wales, down into Victoria, the demand from those buyers to take cattle home and restock well, not necessarily restock numbers, but particularly buy cattle for a backgrounding trade in 2025. The demand from those producers, because those northern New South Wales, Queensland areas can handle a lot of cattle, it effectively put a floor in the price, from day one once they started operating in those markets. And it was really a positive outcome because it had a big support on how the southern producers felt about their outlook for the year, which I'll touch on a bit later as well, simply because of that, that market strength underpinned by the northern interest. Moving past that, though, when we look at how supply's ticking along so far this year, I touched on slaughter and export volumes, both very good. But when you look also at, how the physical movements of cattle are going, they're also very strong. Yardings, for example, generally across the board year-to-date are ahead of year-to-date 24 figures. And when you combine the physical movement of stock, the ability for us to process them and subsequently the volumes going overseas, that combination of those three factors, in my eyes, continues to reinforce the idea that we're moving to cyclical highs in the cattle cycle. Yes, there's been some seasonality to it, no doubt. The flow of cattle in May, for example, particularly after April being so wet and a short working month, April really kicked into gear, but now we're starting to see some numbers soften into a bit more stability as we move into winter. There's no doubt there's a seasonal aspect to the flow and changes in cattle supply, but generally the numbers have been stronger than historical performance. And I think that collectively, when you start looking at the production figures like slaughter and exports, it does tell you we're on the way to those cyclical, highs in the cycle. When we think about, saleable cattle in the first 6 months of this year, we've got to remember, they were carved down in 2024 or 2023. So there is that elongated long lead time for stock to reach saleable weights and be processed, So when we think about how the strength of numbers have been so far this year, and then add on the fact that the North has just had its 5 successive average to above average wet season, when we have this conversation in 12 months, we shouldn't be surprised, with the volume of cattle available then as well. And I think at the minute, it's a good reminder to think back to when these cattle were actually, conceived, carved down, and now they're hitting the market or the supply chain at this point in time. And it's a good reminder of that. Another aspect, that it certainly surprised me, and I know it surprised some others when we talk about cattle supply, is the strength of numbers coming out of the south for the first 6 months of this year. I think we all thought that southern supply was going to dry up, March, April, and southern processors or buyers in general would have to be coming north a lot earlier or sooner than what they seasonally would. It just didn't happen that way. And I think there's two factors to it. The first one, no doubt, is the drought. Arguably it's gotten a lot worse over the last 6 months than it was prior to this year starting. So the producer had no choice but but to offload stock, in relation to cost of feed, water availability, all those sorts of things. So there was definitely the drought aspect to it. But I think alongside that is, there's more cattle in the south than we probably realise. It's something I've mentioned on this podcast at a national level or generally anyway, and it just shows you that there are the numbers there. This was a stressed situation whereby the cattle weren't flowing because it was a choice. They had to move because there wasn't a choice. But I think it's a good reminder of the number of cattle we have around us and the strength in supply at present, despite the effects of drought and liquidation of stock in those southern cattle areas. But moving past that and looking at price, what I would start with is there's no doubt in my mind that if those northern rains in March didn't come, the market would be in a materially different position to what it is today. One way to put it, the northern rains, the March rains in the north pretty much saved the market for 2025. As I mentioned not long ago, the market was in I would say, precarious position. It was on a bit of a knife's edge with the volume of cattle starting to move out of certain locations, the fact that the north hadn't had a season, and even northern New South Wales, Queensland starting to get very dry after a good spring, and some early or some December rains in summer got things going. The start of the new year wasn't great, and then that rain turned up and pretty much saved it. The market wouldn't be where it is at the minute without those March rains. Looking past that though, considering, as I've said and just discussed, how strong supply has been, prices have been solid right across the board, from your restocker, background to cattle right through to cows and your grass-fed slaughter stock. I think that's a good outcome, and it reflects the nature of the market at the minute. I would probably call it, for the first 6 months of this year, balanced and somewhat sustainable for all parts of the supply chain. That's at a general level, but I think, when you're looking at some level of profitability from the producer right through to the exporter, that's a fairly unique occurrence. We don't get that all that often, and I think the way the market has remained relatively stable and operated in a pretty tight band across most categories for the first 6 months of this year, that outcome has allowed profitability across the supply chain. And I think that's something that's quite unique. What I would say in a further sort of sense to that is the strength in feeder and, processor or exporter cattle type prices have been quite good. Again, I don't think this should come as a surprise. When we're in a situation like we are now, where the cattle cycle is reaching production highs, the focus, it becomes a buyer's market. And when you look at, generally how, well, take cows, for example, in the last 2 to 3 weeks have performed, there's only a finite availability of those stock in the country, but the demand is strong. Processors have the ability to get through big volumes of numbers, which I think that 630,000 head figure in front of 2024 numbers indicate. When you've got that combination of a finite resource and competitive tension chasing the same article at a time when southern slaughter supply is getting very tight, which is seasonal, you can see that upward pressure naturally has to come. And it does generally always come in the winter months of each year. It's a good example of it being a buyer's market, but also the fundamentals of supply and demand and the resilience in the price, despite, more broadly across the market, not necessarily cow specific, good, strong availability of cattle. If I look past that though, I'll jump into the global space. I think there's probably, in my mind, 3 things that have happened this year which deserve a mention. 2 of them are generally market specific on the export front, and the third one is obviously Trumpy and his tariffs. I'll start with that, and I had a look at some of the data in and around that time, and I isolated processor cows because I think it showed it the best. Pretty much 2 weeks either side of the announcement of tariffs on Liberation Day, the processor cow price had a swing of 52 cents a kilo live weight, or 18% within the space of that month. So the market really rallied prior to April 2nd when those tariffs were announced, and then fell. It was about 30 cents after those prices. After that announcement was made. That level of volatility in the market, that's nearly, that level of volatility in carcass weight terms, 50 cents works out at about $1 a kilo carcass weight. 20% is a big swing in a market in the space of a month. And I think, the uncertainty that that situation and tariffs created, and it wasn't just isolated to livestock markets. You've only got to look at the share market and the dollar. But that level of uncertainty was effectively artificially inflated and then depressed the market within the space of a month. When you look back on it and you actually look at how that market performed, because of the announcements and the uncertainty around what it was going to be and how the market was feeling, and the processors and exporters themselves didn't know, it was quite a unique situation. When you look at the actual pricing performance, there's just this little spike and then it comes back down to where it was supposed to be. But it's a big swing in the space of not long. And I think it does reinforce the volatility and the risk the market carries. That's one example of an artificially inflated and or depressed market over a month. But it's a good example of how, even though supply and demand drives Australian cattle prices, that's the focus, local supply and demand, that's what determines market price performance. But the uncertainty around tariffs and what that meant, it's a good example of the exposure and the risk the market carries because of reactions to, global geopolitics in this instance, or whatever you want to call it. There are other things that can creep into our market. Biosecurity is another one. Great examples, that 2022 situation with FMD, where the market fell off a cliff for the space of about 6 or 8 weeks and then recovered all of its gains very quickly. It does show you how market uncertainty and in this instance, global geopolitics can have an effect on our livestock prices, even though it's not necessarily the fundamental driver of price performance. But, with a situation like what's happened with tariffs, what I was really pleased to see was that the local market and prices didn't get spooked or react in a really negative way. It held its ground. It pretty much carried on how it should have. I think it's a good outcome that there wasn't too much emotion involved in the market around this time. It was a concern I had, particularly with 2023 in the back of my mind about how the market reacted to a weather forecast. So that was a really pleasing thing to see, was the market held firm and just got on with it. Prices, weren't materially affected by that announcement. But with the announcement did come some opportunities. And generally, as an example, you've seen some good inquiry from other countries looking to Australia to satisfy their beef needs. And because we are recognised as a reliable supplier, I think can only be a good outcome for us. Look at the Chinese inquiry back to Australia for product after their spat with the US that's ongoing, and subsequently the effective banning of a couple of hundred beef plants to export into China. The Chinese are now looking to Australia, to us, to see what we can deliver them. There's a host of other examples. The EU was suddenly back to the table wanting to discuss a free trade agreement. Again, that's basically a product of the disruptance and the uncertainty that America and Trump has created with this tariff situation. So there's good and bad to every side of the story, but generally I would take, Trump's announcement as a pretty good outcome for Australia, because we're seeing that inquiry from other countries. And like I mentioned in the cattle market locally, competitive tension is a good thing. That that supports not only stability but demand, and I think demand is important. When I talk about demand, to me, it's more important than seeing export beef prices at sky high levels. I think we need the demand before we worry about how export prices are performing. Without the demand for the in 2024 is a good example, or even the 6 months of this year, nearly 1.5 million tonnes of beef we've produced, and roughly sort of 700,000 tonnes we've exported. Without that demand, we'd have a lot bigger problems. The market would be in a materially different position if we didn't have all these countries wanting our product. And I think that's a really big tick on the Australian beef industry, and it has been for a long time. But the first 6 months of this year is the demand for what we produce, and we're seeing that across the board. The one I like a lot is the growth in these emerging markets, both in a cyclical sense and non-cyclical. And what I mean by cyclical and non-cyclical is a good example is places like Mexico and Canada, particularly Canada. When you look at its last sort of highs in the volumes it took from Australia, that was in 2014-15 when the US and Canadian beef industry was going through its own rebuild. So it's really cool to see that Canadian interest pick back up, because they themselves are going through their own beef production and availability challenges, and they look to us as a supplier to lift those numbers. Looking away from those or cyclical markets like Canada, I think just generally the continued emergence of these what I'm calling emerging markets, Malaysia, the Philippines, UK, Taiwan, 4 great examples. Strong year-on-year growth in export volumes. 3-4 very different markets, all taking different products. And, I think it's great to see that continual improvement in the volume, of product they're taking from us. And as I mentioned, the demand is there. They want what we're producing, and I think that's a really positive outcome. When you look at the big 4 markets, obviously the US is the highlight by far and away. It's just killing it at the minute in terms of the volumes that it wants from us, and it's no wonder with cattle numbers at 70-year lows. And when you look at the data, on fed and non-fed beef production coming out of the States, it's falling week on week at a fairly significant rate. So it's great to see that the US is there. They obviously want what we're producing. But another real positive out of the export market, South Korea. Already South Korean volumes, they're about 12% in front of 2024 year to June figures. Last year's South Korean exports were at records, 200,000 tonnes. So, another major market of ours takes anywhere from sort of 16 to 22 or 3% of our export volumes in total. So it's a big market. They're taking good volumes of our product. When you look at China, the inquiry from China's been quite strong. They're looking to us as a solution to the spat they're having with the States at the minute. And, they want to look to us to satisfy their needs. The export numbers, they're up about 33% year to date compared to last year into China. They reflect that demand is there. But I think the situation Australian exporters and the beef industry is faced with is how does it balance that exposure? Businesses effectively lost a market overnight, 2020 to 21, and how it goes about dealing with that and that inquiry will be a really interesting space to watch. That's all we've got time for this week in the wash-up of the first half of this year. On the next episode, I'll dive into the recently released StoneX H2 2025 Australian Cattle Market Outlook report. We'll release it on the 14th of July. I'm going to cover my updated forecast for 2025, key production figures, herd size, slaughter, beef production, exports, carcass weights, and live exports. And then I'll also share my views on the outlook for pricing, how I think supply and demand is going to play out, and then also what some of the opportunities and risks are in the market. Things like a southern herd rebuild, and then a broader outlook picture for the beef industry for the second half of this year. I did get a question from Joe in Central Queensland last week. Joe asked me, you mentioned on your latest episode how the southern states were optimistic despite drought conditions getting worse over the last 6 months. Why do you think that's the case? I mean, it's a fair question when you look at some of the data coming out of MLA's Beef Producer Intention Survey that says, generally optimism is improving in areas that have gone through one of their worst droughts in living memory for a lot of places. I think, Joe's question, how does that happen? What I'd probably say is those southern producers recognise the optimism and the medium-term confidence in Australia's beef industry. I've spoken about it a bit today. There's demand for our product. People want what we're producing. The outlook is generally pretty good. And, I think people are reminding themselves the beef industry is a great place to be in. And clearly these southern producers are passionate about what they do. They see confidence and a long-term future in the sector, and they want to be a part of it. But I think moving into some of the more nitty-gritty stuff, producers in the south have effectively gone through, or they're going to at some stage, 2 cycles of this rebuild liquidation in the space of sort of 7, 8, 9 years. That's quite fresh in their minds. And I think when they think about that, they recognise, it wasn't that long ago, 4 years ago, we're in the situation of a rebuild nationally. They're clearly aware of that situation that's coming, and it has to come because of the conditions that they've dealt with. And I think alongside that, like I've spoken about in this episode, is the markets themselves. Prices have been really solid. The demand from northern buyers for southern cattle, both at the weaner sales when a lot of those southern producers have their paycheck for the year selling their weaner drops, right through to people selling cattle into now even in the market in those southern regions. Despite the drought, it's the price they've received has justified the feeding, and that gives them some optimism to keep doing what they're doing. I think if you're selling your weaners for $3 and your feeders for $2.50, that wouldn't be the case. But the prices they've received has justified the cost of feeding, and it's also left them in a more optimistic mindset than if the market wasn't, or hadn't behaved like it had in terms of its stability and strength for the first 6 months of this year. So, as usual on that, questions are always welcomed. So if you've got one or someone does, and they want something answered, do like Joe has done, send me an email to ripley.atkinson@stonex.com, or record a voice note of yourself, where you're from, and the question, and it'll be answered on the next episode. Remember to share the podcast with any of your mates or people that might be interested in hearing a bit more about the market. But until then, thanks for listening, take care, and we'll see you next time. Cheers.